We've got Anand Goenka, Managing Director of Ceat, who's now joining in on the show. Mr. Goenka, thanks very much for being with us. To start off with, you've got rubber prices which have come down substantially. How do you see that aiding your margins?
Yes, rubber prices, particularly internationally, have come down a fair amount. So from about $3.4 per kg, they have now come down to about $2.9 per kg. Indian prices, on the other hand, have remained at similar levels, so a minor reduction from about 190 rupees per kg to about 185 rupees per kg. So a lot of the imported rubber which we will be procuring now, which will only start coming in and getting utilized around the end of August, we will result in an improvement in margin. So that is, we expect an improvement only from the end of August, early September onwards.
Right, and what kind of volume growth do you see coming in this year, considering that expectations for vehicle sales now have been curtailed? Or do you expect the replacement market to, the growth in the replacement market to compensate for the loss that you see on the other side?
Yes, growth in the replacement market has not yet been affected. However, in the OEM segment, we are seeing a slowdown. Fortunately for a lot of us, a large part of our business does come from the replacement market, and therefore we feel that overall, yes, there will be a minor impact, but not a very large impact. However, we are seeing some slowdown in the export market because of the global economic situation as well. In Latin America, the Brazilian real has depreciated, where imports are becoming expensive. Europe, things are looking difficult. So in the OEM and export market, there is some impact. However, replacement market, at least until now, things are looking okay.
And in light of the fact that the auto sales have been impacted on higher fuel prices, do you think we can see a further downside when it comes to the demand for tires?
Yes, I think for the next few months, things are looking to be not too bright, at least from the OEM segment. Interest costs are high. Macroeconomic situation doesn't seem to be improving going forward, at least in the short term. So I do believe that OEM demand will be sluggish for at least the next 3 to 4 months.
Right, and Mr. Goenka, CapEx for the current financial year, how do you plan to fund this?
Yeah, most of the capex is actually normal capex that we would be doing in our current plants. That would be about 50 crores for molds and regular capex items. The main capex that we would really be looking at is our investment in Bangladesh. So we are looking at setting up a new plant there, and we would be looking at acquiring some land. So some of that investment will be going in this year, approximately 40 to 50 crores in that investment for FY13.
And before we let you go, walk us through your FY13 outlook on growth as well as the margin picture.
So growth certainly is slightly slower than what we had initially expected in the year because of the various reasons we have already discussed. However, on the margin side, I think margins could be as per expectations or maybe even a little bit better because of the slowdown in raw material prices. So if raw material prices continue to be at these levels, we can expect better margins from about September, October onwards.